Welcome back to Road to Fire. We're a family of three documenting our journey to fire, financial independence, retire early. Let's chat about our top 5 Vanguard index funds to help us reach fire. I will share details on each fund, rate of returns, and why we have this in our current strategy with all real numbers like always, so please hang with me. So I recently learned about the power of index funds. In fact, it wasn't until I started reading about FIRE did I learn about how to build an investment portfolio with all index funds. I'm embarrassed to say that I only started investing in index funds about 5 years ago, so I'm definitely a novice when it comes to this. But I've learned so much in a short amount of time. I try to allocate time each month to learn about financial literacy and it has become very important to me not only because I want to reach FI, but because I want to pass this knowledge down to my son as well. No one sat down with me to talk about finances, and I envision myself having series of coffee chats with my son when he gets older just about finance, but especially about index funds. So what is an index fund? An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. Index funds have lower expenses and fees than actively managed funds. Index funds follow a passive investment strategy, which I absolutely love. Now, an index fund is a type of mutual fund, but its holdings match or track a particular market index. It's 100% hands off, and you could build a diversified portfolio earning solid returns using mostly this type of investment. But keep in mind though, index funds don't try to beat the market or earn higher returns compared with the market averages. Instead, these funds try to be the market, buying stocks of every firm listed on an index to mirror the performance of the index as a whole. So index funds can help balance the risk in your portfolio, as market swings tend to be less volatile across an index compared with individual stocks. So index examples. The first is the S&P 500, which is an index of performance of the 500 largest U.S. public companies. Then there is the Dow Jones Industrial Average that tracks the 30 largest U.S. firms. You can also have the NASDAQ, which tracks more than 3,000 technology-related companies. Then there's also the Russell 2000 Index, which tracks 2,000 smaller companies or small cap. These are just a few examples, but there are many you can choose from. So here are 3 key benefits when investing with index funds. First, index funds have very low fees because they are passively managed. We chose Vanguard index funds because their ratios are about 83% lower than the industry average. Number 2, broad diversification, which helps mitigate long-term risk. You are essentially gaining a piece of many companies versus putting all your eggs in one basket when investing with individual stocks. And number 3 is the great returns. I will outline our funds returns in the last 5 years, but if you review data long enough, you will see that index funds tend to outperform most fund managers over a long-term period. Also, one of my favorite quotes ever about index funds comes from the Warren Buffett. He said this back in the early 2000s, and I quote, "If I were going to put money into an index fund in relatively equal amounts over a 20 or 30-year period, I would pick a fund, and I know Vanguard has very low costs. I think that people who buy these index funds on average will get better results than the people that buy funds that have higher costs attached to them." End quote. Enough said here. Get into index funds. Disclaimer, I'm not a financial advisor and this video is intended for entertainment purposes only and holds only my friendly thoughts and opinions. Now, if you're looking to make adjustments to your investments, consult a financial advisor. Okay, in my opinion, let's start with the best index fund out there, Vanguard's VTSAX. This is the largest mutual fund in the world for 2 primary reasons. It is a diversified stock index fund and its expenses are extremely low. The portfolio provides exposure to the entire U.S. stock market, including small, mid, and large cap stocks. This portfolio mix includes over 3,500 securities. You literally get a piece of everything with this fund. Fast facts. It has a 5-year rate of return of 16.7%, which is amazing. Expense ratio is extremely low at 0.04%, and it's classified as U.S. domestic stock. But you'll need a minimum investment of about $3,000, but don't worry, the ETF is VTI, which is very comparable. I used to say that I never invested in Tesla or Apple, but technically I do because they are included in VTSAX, and so are other great growth stocks. Here are the largest holdings in this fund making up over 22% of the portfolio. Now it doesn't get better than this, but I will share one fund that did better than VTSAX in the last 5 years in just a second. Now I can see the benefit of only having one fund in your portfolio. Heck, more than 70% of our investments are in this one fund by design. This probably will change slightly, but this strategy has proven to work really well for us so far. But if you've read The Simple Path to Wealth by J.L. Collins, he is all about this fund and advises those early on in their FIRE journey to stock up on this one fund alone. Not our strategy, but I do get his thought process. Risk is medium to low, returns are amazing, and expenses are very minimal. The perfect combination, honestly. But there are other options you can add into your portfolio as well. So number two is Vanguard's VFIAX. This fund tracks the S&P's 500 index, which means it holds about 500 of the largest US stocks. So with this fund, you will get exposure to the best of the best. This fund is a smart choice for investors who want to build a portfolio that includes a small, more elite pool of companies. While VTSAX has over 3,500 securities, this narrows the list down to a select 500. So fast facts, the 5-year rate of return was 16.3%, which is still great, but not as great as VTSAX. Expense ratio is the same at 0.04%. It's still classified as U.S. domestic stocks, and the minimum investment is $3,000. Again, the ETF here is VU, which is very comparable. So the top holdings are identical to VTSAX, but weighted higher at 28% versus 22% in this fund due to the difference in the total number of securities overall. Now, number three is Vanguard's VBTLX. I know, not everyone agrees on having bonds in their portfolio. I did get a few comments on this in my last video, but if you want to hedge some of your risk, it's not a bad idea. Again, I'm not a financial advisor. Bonds represent less than 1% of our portfolio right now, but I'm working to make it closer to 5 or 7%. So find the right balance based on your own personal risk tolerance is key. Now, to offset risk with bonds, this is the fund we will choose. This fund's portfolio has more than 9,000 U.S. government and corporate bonds. So fast facts, the 5-year rate of return is about 3% or in line with inflation. Expensive ratio is about 0.05%. Asset classification is intermediate bonds. Investment needed is still $3,000, and the ETF here would be BND. As expected, the portfolio composition is really U.S. government holdings, the bulk of the share. Let me know in the comments what percent of bonds make up your total portfolio. I'm curious to see the different strategies when reaching FIRE. So we never thought about having international stock funds until we read about the Swenson model. I did make a video on asset allocation which outlines this portfolio's makeup. For now, having some international stock funds in our portfolio is a must. We have very little in our portfolio right now, just about $3,000, but intend to grow this over time. So number four is Vanguard's VTIAX, and it's one of the best Vanguard funds to help us get global exposure. This fund tracks an index that includes over 6,000 non-US stocks, including both developed worlds, Europe and Japan, and emerging markets like China, India, and Brazil. Obviously, Sub-Saharan Africa is missing for sure, and I'll get to that in another video. So, fast facts again. The 5-year rate of return is 9.9%, lower than the other options, but still a great return overall. Think about this as a way to hedge for long-term risk, a slightly higher expense ratio, and it's classified as global or international stocks. And again, you'll need a minimum investment of $3,000, but there is an ETF, VXUS, that can help you get your foot in the door. I own single shares of BABA already, which has been good to us, but here are the top holdings in this fund. Note the top holdings only represent 10% of the portfolio, which shows the vast diversification in this option. Stable and solid companies here overall. Now you can build a solid portfolio with just these 4 funds. In fact, this is how we set up our fund until we found number 5. But I come to realize that you can always adjust or shift or rebalance your portfolio anytime throughout your journey. We are working in Q2 to rebalance our portfolio to help us better serve us in the future. I always felt that I need a set it and forget it strategy, which is what passive investing is, but you can always change your mind anytime throughout your strategy and make changes as you need it. We are building the right mix and assortment that will help us reach our financial goals in our desired timeline. So, which fund beat VTSAX? This one. Vanguard's VIGAX had a 5-year return of over 20%, nearly 4% higher than VTSAX. This index fund holds large cap growth stocks that have historically outperformed the S&P 500, especially within the last 10 years. We just added this one to our portfolio. Its 1-year return was over 64%, which is just bananas, but last year was definitely a unicorn year. Fast facts. The 5-year rate of return is at 20.6%, which is amazing. Expense ratio is a little bit higher than VTSAX at 0.05%. It's classified as domestic stock, and again, the investment needing is $3,000, but the ETF here is VUG, available for anybody at that individual share price. Note the percentage of these holdings of the top companies are over 46%, almost like holding an individual stock, almost basically. Now, I never heard of this index fund until we started building our ideal portfolio a few months ago. For those looking for a bit more diversification, there is Vanguard's VGSLX, a real estate or REIT index fund. We don't hold this in our portfolio, but we do hold REITs overall. This fund invests in real estate investment trusts or companies that purchase office buildings, hotels, and other real estate properties. REITs have often performed different than stocks and bonds, so I can see the need for this in your overall portfolio. Fast facts. The 5-year rate of return is low for me personally at 6.3%. Expense ratio is a little bit higher at 0.12%, and the asset classification is stocks or real estate stocks. And the minimum investment again is $3,000, but there's an ETF option called VNQ. Here are the 10 largest holdings. We don't own these companies individually, but I do love the mix of companies here. I had Public Storage on my watch list, so it was interesting to see them on this list. So would I recommend this fund? I don't know as I don't own it, but I do see the benefit of having REITs in your overall portfolio. We are working to add more REITs, but more than likely not this fund for the long term. So overall, build your own optimized portfolio for FIRE. There is no right or wrong answer or path. Don't copy someone else's portfolio, do your own research, and find the right mix that makes sense for you and your timeline. I think we're finally in a good place with our portfolio. I don't see any major shifts in the near future, just tweaks and rebalancings along the way. I want to create a portfolio that requires little to no investment or time in the long run so it can be truly passive. Now, I have shifted my mindset from mimicking what others are doing, i.e., copying, to becoming more confident in making and building the right mix for us. It's a not complicated overall. Once you understand your goals, risk level, and timeline, the rest is easy. Now, if you made it this far, thank you so much for watching. But don't forget to like, comment, and subscribe below. Until next time.